Okay, so you want your own strip club. Rent a building, hire some dancers, put up a neon sign, and watch the cash pile up. No skill required, no product to perfect, just a room, some liquor, and people willing to pay to be in it. That's the version people assume. Owners driving nice cars. A pure cash business. Lines out the door on a Friday night, and someone in the back counting stacks of 20s before close. That's the myth. The strip club as an ATM with a stage bolted to the front of it. The one business nobody thinks requires an MBA because desire sells itself. Here's what nobody shows you. The owner you're picturing spent 6 figures just getting permission from the government to open the door. They fought a zoning board for 18 months. They pay a small army of dancers who technically don't work for them at all in a legal arrangement that gets challenged in court on a regular basis, sometimes successfully, sometimes for millions of dollars. And on a good month, after every fee, every lawsuit reserve, every insurance premium, they might clear a profit margin that looks a lot more like a restaurant's than a printing press. That's the real version. And understanding why it looks so different from the fantasy is worth your time, especially if the cash business mythology is the reason you're curious about this in the first place. The first number people search is how much it costs to open one. And there's a real answer, but it's wider than most people expect. A modest, medium-scale club in a secondary market with a modest build-out can be open for somewhere around $250,000 to $320,000. That number covers a leased space, basic construction to code, a stage, seating, sound and lighting, a bar setup, and enough working capital to survive the first few uncertain months. Sounds like a lot, but manageable. Here's the first trap. That number assumes you already have your liquor license, and in most major cities, you don't. You have to buy one. In a state like California, a full liquor license for a bar or nightclub, the kind that lets you sell hard alcohol, not just beer and wine, is capped by a quota system. The state only issues so many per county, and in most major metros, that quota has been maxed out for years. So you're not applying for a license from the state. You're buying one on the private resale market from someone who already has it. In Los Angeles or San Francisco, that resale price runs anywhere from $100,000 to over $400,000, depending on the neighborhood and how badly you need it. Add legal fees to get the transfer approved, another $5,000 to $15,000. Add the conditional use permit process, another $3,000 to $20,000. Add 6 to 9 months of dead rent while you wait for approval, because the space isn't generating a dollar of revenue while the paperwork moves through City Hall. Put a serious, code-compliant, fully licensed adult club together in a first-tier American city, and a realistic all-in number lands somewhere between $500,000 and over $1 million. That's before you've hired a single dancer, before a single customer has ordered a single drink. And unlike a restaurant or a bar or almost any other hospitality business, you're not just clearing one regulatory hurdle. You're clearing several, stacked on top of each other, and each one exists specifically because of what your business is. Every adult entertainment business in the United States needs a sexually oriented business license on top of a standard business license. That license alone can run $1,000 a year in a smaller municipality, but it comes with something a coffee shop license never has: zoning distance requirements. Most cities require an adult club to sit a minimum distance from schools, churches, parks, daycares, and residential zones. That distance ranges from 300 feet in some California cities to 1,500 feet in others. In Los Angeles, adult businesses also have to sit a minimum distance from each other, which means the available real estate that legally qualifies for a club in a huge city might only be a handful of parcels. Find one of those parcels, and you're paying a premium for it, because everyone else chasing this business is fighting over the same short list of addresses. Here's the part that catches new owners off guard. Nudity and alcohol don't mix the way people assume. In many jurisdictions, including Las Vegas, a club can serve full liquor if the dancers stay topless. But if the club goes fully nude, alcohol is banned from the premises entirely. That single regulatory line determines your entire business model before you've designed a single room. A topless club with a full bar is one financial structure. A fully nude, alcohol-free club one that survives on cover charges and dance fees alone, is a completely different one. You don't get to choose both. Every one of these permits renews. The sexually oriented business license renews annually, usually with a new background check on ownership. The liquor license renews annually with its own fee schedule. Local health permits, fire inspections, occupancy certificates, they all renew, and they all carry the same quiet threat every other regulated nightlife business faces. Any one of them can be pulled, and if it's pulled, you don't have a business anymore. You have an empty room with a stage in it. Now let's talk about the part of this business that makes it structurally different from almost anything else in hospitality. The dancers themselves aren't your employees. In the overwhelming majority of clubs in America, dancers are classified as independent contractors. They don't receive a paycheck from the club. Instead, they pay the club. It's called a house fee, sometimes a stage fee, and it's charged just for the privilege of working a shift. According to a Washington State Department of Labor and Industries report, those house fees typically run between $65 and $165 a shift, averaging over $100. On top of that, many clubs take a cut of whatever a dancer earns from private dances, and some require tip-outs to the DJ, the bouncer, and floor staff, on top of the house fee itself. Think about what that structure actually means from the owner's side. The dancers are simultaneously your product, the reason customers walk through the door, and one of your revenue streams, because they're paying you to be there. It's less like hiring staff and more like renting stage time to independent operators, the way a barbershop rents chairs to barbers who keep their own client list. It sounds efficient. In practice, it's the single biggest legal exposure this business carries. Because whether a dancer is truly an independent contractor or is legally an employee who's simply been mislabeled, has been tested in court over and over again, and clubs keep losing. Courts look at who controls the schedule, who sets the rules on appearance and conduct, who's essential to what the business actually sells. Dancers usually check most of those boxes as employees, not contractors, no matter what the contract says. A 2023 lawsuit against a Birmingham, Alabama club, and a similar case involving a Phoenix chain that ended in a $6 million settlement in Florida, both followed the same pattern. Dancers arguing they were owed minimum wage and overtime under federal labor law because paying to work and then having tips redistributed to non-tip staff doesn't hold up as a genuine contractor relationship. This is why any club owner who's been in the business more than a few years treats a portion of gross revenue as an ongoing legal reserve, not a hypothetical. It's not a matter of if a wage and hour claim shows up. It's a matter of when and how big. If you're finding this breakdown eye-opening, hit subscribe and drop a like. It helps more people find videos like this one. Let's get precise about where a single dollar actually goes once it crosses the bar, because this is the number that matters more than any other. A customer orders a $12 drink. The club didn't earn that whole $12. Sales tax comes off the top first, somewhere around 8% in most cities, so you're down to roughly $11.04 before a single cost has been counted. Now subtract the pour cost what the actual liquor, mixer, and garnish cost the bar. On a well-run beverage program, that's roughly 18 to 22% of the sale price. Call it 20%, so about $2.40. You're at $8.64. Card processing takes its cut, typically 2.5 to 3% plus a flat fee per transaction, another 40 cents or so. Now you're around $8.24. Then payroll. A bartender at a club like this earns a base wage plus tips and the fully burdened cost of the house. Once you add payroll tax and workers' comp, runs a few dollars per hour allocated across however many drinks that bartender pours in a shift. Security is non-negotiable in this business in a way it simply isn't for a normal bar, and a club typically runs one security staffer for every 40 to 75 guests on a busy night. Spread that labor cost across the drink volume of a shift, and you're shaving another dollar or so off that $12 ticket. What's left, once every cost has taken its bite, is a contribution margin that's healthy, but not the fantasy number people assume. That's before rent, before the liquor license amortization, before insurance, before marketing, before a single house fee has offset a single dollar of overhead. And that's just the bar side. Because the other engine of this business, the one that actually decides whether a club survives, is the VIP room. Cover charges and drink sales keep the lights on. Private dances and VIP room time are where real club revenue concentrates. In a split, there varies enormously by club, but the house typically keeps somewhere between 20 and 50% of what's charged for a private room booking, on top of the house fee the dancer already paid just to be on the floor that night. Insurance in this business isn't optional, and it isn't cheap. General liability, which covers customer injuries and the kind of incidents that come with alcohol and close-contact entertainment, runs meaningfully higher than a standard bar's policy, often several times higher, because insurers price adult venues as elevated risk. Liquor liability, covering incidents connected to overserving, is its own separate policy. Add employment practices liability insurance, which exists specifically because of how often this industry gets sued over worker classification, and a club's total insurance bill can run into the tens of thousands of dollars annually before a single claim is ever filed. Marketing looks different here too. Most advertising platforms, Google, Meta, restrict or outright ban ads for adult entertainment venues. That means a strip club can't simply buy visibility the way a restaurant or a regular nightclub can. Clubs lean on direct relationships instead. Local promoters, hospitality industry referral networks, VIP host programs, and word of mouth. That's not a cheaper form of marketing. It's a labor-intensive one, and labor is a cost too. Here's why the operational rhythm of this business matters so much. Unlike a restaurant, which earns money across lunch and dinner every day, a strip club's week is lopsided. Thursday through Saturday night typically carries the overwhelming majority of weekly revenue. A Tuesday afternoon shift might not cover the cost of having the doors open at all. That means every fixed cost, the rent, the liquor license carrying cost, the insurance, the base security staffing, has to be earned back inside roughly 3 nights a week. Miss those nights to bad weather, a local event competing for the same crowd, or a slow economic stretch, and there's no Tuesday lunch rush to make up the difference. Let's talk about a real example, because this business has a publicly traded company in it, and its numbers are unusually transparent for an industry that isn't. RCI Hospitality Holdings trades on the NASDAQ under the ticker RIC. It owns dozens of clubs across the country, including well-known brands like Rick's Cabaret and Tootsie's Cabaret, along with a chain of sports bars. In its most recent fiscal year, the company reported close to $280 million in total revenue. That sounds like the fantasy version finally showing up on paper. But look closer at what building that scale actually required, and it's the opposite of shortcut. RCI grew almost entirely through acquisition, buying already profitable, already licensed clubs rather than building new ones from scratch, specifically because opening a new club from zero, clearing zoning, winning a liquor license, is slow and expensive enough that buying an existing operation is often the faster path to profitability. The company's own strategy explicitly allocates a portion of free cash flow just to acquiring more licensed clubs because the license and the zoning approval are, in a very real sense, the actual asset being purchased, not the building. And even at that scale, with decades of operating experience, the legal exposure never disappears. In 2025, RCI and several of its executives were indicted in New York on charges connected to a scheme allegedly bribing a state tax auditor to avoid paying millions of dollars in sales tax. The company's stock dropped sharply on the news. That's not a story about incompetence. It's a story about an industry where the regulatory and legal risk scales right alongside the revenue. Bigger club chains don't outgrow the exposure. They just face a more expensive version of it. At some point, a successful single club owner starts thinking about opening a second location. Double the clubs, double the revenue. The logic seems clean. It isn't. For the same reason, it isn't in almost any owner-operated hospitality business. One club, run by a hands-on owner, means one person who knows exactly which dancers are reliable, which bartender is quietly shorting the register, and which regular just became a problem. At a second location, and you need a general manager you trust enough to make those calls when you're not there, in an industry with a margin for a bad hire, a mismanaged VIP room, an unenforced house rule that turns into a lawsuit, is thin. The revenue can double. The exposure to something going wrong doesn't just double. It multiplies, because now there are 2 rooms you can't personally watch every night. There's a revenue channel that sounds like the answer to every slow week: private events. bachelor parties, corporate outings booked quietly, a touring act's after-party. A single large private booking can generate more revenue in one night than an average Tuesday brings in over a month. That number is real. What's also real is that private events concentrate risk the same way they concentrate revenue. A large group, alcohol, and a late night is exactly the combination that produces the incidents insurance premiums are priced around in the first place. Let's put real numbers on what a single, modestly successful club looks like over the course of a year and what a bad stretch looks like too. The steady scenario. A mid-sized club in a secondary market, license and build-out already financed, running a loan payment of roughly $4,000 a month. On a solid month, the club brings in $180,000 in gross revenue across bar sales, cover charges, and a house's share of private room bookings. Poor cost and direct bar expenses run about 20%. That's $36,000. Base staff payroll, bartenders, security, floor management runs around $45,000. Insurance, the liquor license carrying cost, marketing, and a legal reserve set aside for the wage and hour claim that eventually shows up, another $25,000. Rent and utilities, $18,000. Loan payment for $1,000. Total costs land around $128,000. Net profit for the month, roughly $52,000, which sounds strong until you remember it's one good month, not every month. The rough stretch. It's late winter. A competing venue opened 2 blocks away with a promotional discount that's pulling in the Thursday crowd. A dancer who was owed back pay under a misclassification claim just settled for $40,000, a cost that landed in a single month, even though the underlying issue built up over years. Revenue drops to $95,000. Fixed costs don't drop with it. Rent, insurance, the loan payment, the license carrying cost, they arrive exactly the same regardless of how the month went. The club nets a loss that month, on paper, once the settlement is accounted for. That swing, tens of thousands of dollars between a good month and a bad one, is the actual shape of this business. You don't get to choose which month you're in. You manage the legal exposure, control the fixed costs, and build enough of a cash reserve that one settlement or one slow season doesn't sink the whole operation. Zoom out to the industry level, and the picture gets more sobering, not less. According to IBISWorld's most recent industry data, the U.S. strip club industry generates roughly $4.2 billion in annual revenue, spread across just under 3,900 licensed businesses nationwide. And the trend line is not the one the fantasy version assumes. The industry has been shrinking, not growing, for most of the past decade, declining roughly 1% in the most recent year alone. As cultural attitudes shift, younger consumers spend differently on nightlife, and cities keep tightening the zoning and licensing environment rather than loosening it. This is a mature, consolidating, legally embattled industry, not a growth story. The clubs that actually survive and turn a real profit share a set of characteristics that have almost nothing to do with how good the entertainment is. They secured their liquor license and zoning approval before committing to a lease, not after, because dead rent during an 18-month approval fight has killed more than one launch. They budgeted a genuine legal reserve for worker classification claims from day one, rather than treating the first lawsuit as a surprise. They built relationships with a compliance attorney the same way a restaurant builds one with a health inspector, as a permanent cost of doing business, not an emergency expense. And they never let the VIP room revenue outrun their ability to actually staff and supervise it properly, because that's exactly where the incidents and the insurance claims and eventually the lawsuits come from. The strip club is not the cash-printing shortcut the myth suggests. It's a heavily regulated, capital-intensive hospitality business with an unusually complicated labor structure, layered on top of a legal risk profile that most other nightlife businesses simply don't carry. It rewards operators who treat compliance as seriously as they treat the entertainment, and it quietly ends the operators who don't. If you found this video useful, please like it and subscribe to the channel if you haven't already. Every single video on this channel takes this same approach. Real numbers, real mechanics, no shortcuts. Thanks for watching.